Yes, results so far came in a little bit better than expected. JP Morgan printed a 16% return on equity, which we expect will lead the industry again. Wells Fargo at 11.7%. We expect similar results from the other banks to report this week. But headlines suggest that a soft landing is imminent. I think that's a bit premature, given that we're still in an extremely complicated operating environment. But we'll see how it all plays out.
Indeed. Just speaking of the operating environment, what guidance did we get from the likes of JP Morgan and Wells Fargo regarding their expectations for net interest income in the coming quarters, as we see rates perhaps coming down in the United States moving forward? Clearly, this is going to have an impact on the sector.
Sure. Yeah, net interest income dominated the conversation. As the equity analysts are trying to model out the numbers. We're not as fixated on that. JP Morgan continues to perform well. On their capital ratios, they finished the quarter over 15%, which is over 300 basis points over the regulatory requirement. As a credit rating agency, we like to see that conservatism. To save their dry powder for, if markets turn. Jamie Dimon echoed that on the call. So, again, expressing conservatism, we think is prudent at this juncture. Net interest income, as I mentioned, equity analysts are just trying to get to a number. We're more fixated on the fundamentals, which, again, remain very strong for bank bondholders. But again, if with lower interest rates, that should improve loan demand over time. But, we're just at the beginning of that. So we'll see, again, how it plays out.
Okay. All right. And we're watching that really closely. Just with regards to what's in your wheelhouse over at Morningstar, with regards to, anticipated regulatory pressures, you mentioned capital requirements as well. Anything worth flagging within the sector right now?
Well, the speech earlier in September alluded to, capital requirements not being as stringent. We'll see how that all plays out. Again, banks are being cautious with buying back stock. JP Morgan stock is trading at 2 times book value, so probably doesn't make sense to buy too much back. But again, the rules need to come out before anything gets finalized. But again, from a credit perspective, banks look to be in very strong shape. Asset quality metrics remain very strong, normalizing as expected. So, that being said, it's a very confusing operating environment. We'll wait to see how things shake out. But from a credit standpoint, fundamentals remain very strong.
And of course, a number of key points being raised during the earnings call as well for both JP and Wells. What concerns you the most right now about the operating environment? You described it as complex. Walk me through it.
Well, obviously, what's going on in the Middle East and in Europe. So how that plays out remains to be seen. Rate cuts just began. Again, I think it's a little bit too premature to say it's all clear. But, on the fundamental side, loan growth came in weaker than, muted it again with only growth in cards. But on the deposit side, outflows continue to stabilize. Deposit costs and other yield-seeking alternatives behavior has calmed down. So, we think net interest margin is on a positive trajectory going to 2025. On the capital markets front, revenues came in stronger than expected. Investment banking fees up more than 30% year over year. Trading results remain very strong, well above pre-pandemic levels. This all bodes well for Goldman Sachs and Morgan Stanley, who report later in the week, who are much less sensitive to net interest income. So, we expect them to report favorable results as well.